Let's be honest, Nvidia is on top of the world right now. They're the engine behind the entire AI revolution. Their success is absolutely undeniable. But that success creates a really interesting paradox, one that can keep investors up at night.
So how can this be? How can a company be so incredible, so dominant, yet its stock could actually be a risky bet from this point on? It feels completely backwards, right? But it's a classic trap in the market. So let's break down exactly why this happens and how to think about it.
To get our heads around this, we need to pull apart two ideas that sound the same but are totally different. First, you have a winning company. This is the business you read about in the headlines. It dominates its market, it has amazing products, and it grows its profits like crazy. Then you have a winning stock. And that's way simpler. A winning stock is just a price that goes up after you buy it. The secret is knowing that these two things are not always the same.
So here's how we're going to break this all down. First, we'll talk about something called the expectation race. Then, we'll look at some simple math that I call the shrinking price tag. After that, we'll explore what happens when your biggest customers become your competitors. And finally, we'll look at some powerful lessons from history.
Okay, let's dive into our first big idea. It's probably the most powerful force in the stock market, and that force is expectations. See, it's not just about how well a company does. It's about how well it does compared to the story everyone already believes. This is the expectation race.
To make this crystal clear, let me paint you a picture. Imagine an Olympic sprinter. She's the best in the world, the defending champion. Everybody knows she's the fastest person on the planet.
So she's at the starting line for the biggest race of her life. The crowd isn't just hoping she wins. No, they are expecting a new world record. In their minds, just winning the race? That's not enough. That's the bare minimum. And bang! The race starts. She runs perfectly. She crushes the competition and wins the gold medal. An amazing achievement, right? But she didn't break the world record. She missed it by just a fraction of a second.
So what happens in the stadium? You hear some polite applause, but you also feel this sense of, oh, her incredible gold medal victory actually feels like a letdown. Why? Because the expectation wasn't just success. The expectation was perfection. And that is exactly what can happen with a hot stock.
For a stock like Nvidia, perfection is already baked into the price. The expectation for mind-blowing growth is the starting line. So for the stock to actually go up from here, Nvidia can't just meet those huge expectations. It has to smash them over and over again. It's a tough race to run.
So that's the feeling, the psychology of it. But how does this disappointment actually show up in the numbers? Well, it all comes down to some surprisingly simple math. Let's look at the two things that really move a stock's price.
A stock's price is basically made of two parts. First, there's the company's profits, the actual money it makes. And second, there's the price tag the market is willing to stick on those profits. You can think of that price tag, which is often called a P/E ratio, as the market's excitement level.
Now, this is where it gets really interesting. Let's walk through this example on the screen. Let's say a company starts with $100 in earnings. The market is super excited, so it gives it a really high price tag of 45 times those earnings. That makes for a stock price of $4,500.
Now, fast forward a few years. The company did incredibly well. Just look, its earnings completely doubled from $100 to $200. From a business perspective, that is an absolute home run.
But look what happened to that price tag. The market's excitement level cooled off. People are still positive, but not euphoric anymore. So now they're only willing to pay 22.5 times the earnings. This is what people in finance call multiple compression. It just means the excitement shrinks, even while the business is still growing.
So what's the end result for you, the investor? Well, the company profits doubled. Awesome. But the price tag got cut in half. Those two powerful forces canceled each other out completely, and the stock price is exactly where it started. You made 0% on your investment even though you owned a fantastic company.
So, is there a way to figure out what expectations are baked into Nvidia's price right now? Well, yeah, there actually is. You can use a tool that lets you work backwards from the stock price. It shows you what kind of future growth the market is already assuming will happen.
And when you do that for Nvidia, the result is, honestly, it's pretty staggering. Right now, the market is pricing in about 47% profit growth every single year for the next 8 years. Think about that. That's like our Olympic runner breaking the world record, then breaking it again the next year and the next for almost a decade.
Okay, so what could possibly derail those kinds of perfect expectations?
Well, ironically, one of the biggest threats to Nvidia might be coming from a very strange place. It's coming from its own best customers.
You have to understand, Nvidia's profit margins are just out of this world. At around 75%, they're making money like a software company, but they sell hardware. That kind of profitability is a giant sign of how dominant they are. It's almost unheard of.
But in the world of big business, massive profits are like a giant flashing sign for competitors. As Amazon's founder Jeff Bezos famously said, "Your margin is my opportunity." And a 75% margin is a very, very tempting opportunity.
But here's the twist. The competition isn't some other chip company. It's Google, Amazon, and Microsoft. These tech giants are spending billions and billions of dollars buying Nvidia's chips. And at some point, they look at those bills and think, hey, maybe we can just build our own.
And that's exactly what they're doing. Google has its TPU chip. Amazon has Trainium. Microsoft has Maya. Their goal is really simple. Spend less money on Nvidia's products. Every single chip they make for themselves is one less chip they have to buy from somebody else. This creates a natural ceiling on how much Nvidia can grow in the future.
Now, you might be thinking this all sounds a bit theoretical, but believe me, this exact story has played out before. History is full of dominant, world-changing companies whose stocks went absolutely nowhere for a very long time.
Let's take a little trip back in time to the year 2000, right at the peak of the dot-com bubble. The Nvidia of that era was a company called Cisco Systems.
Cisco was the undisputed king. They built the plumbing of the internet, all the essential gear that made it work. For a moment, they were the most valuable company in the world. It really felt like nothing could ever stop them.
So what happened next? Well, Cisco, the company, did great. It more than doubled its sales over the next 2 decades. But Cisco, the stock, it was a total disaster for anyone who bought at the peak. If you invested in 2000, you had to wait 20 years just to get back to even. A great business, but a terrible investment.
And Cisco wasn't a one-off thing. Just look at Microsoft. For the 15 years after that dot-com crash, they were still the titans of tech. Windows and Office had a total monopoly on personal computers.
Over that decade and a half, Microsoft's business was a beast. It tripled its profits, an amazing performance. But the stock price, it went nowhere. For 15 straight years, it was basically flat. All of that incredible business growth was just enough to catch up to the sky-high expectations from the year 2000.
So this brings us right back to Nvidia today. For its stock to be a great investment from here, it has to do 3 almost impossible things. It has to defy the law of large numbers and keep up its explosive growth. It has to defy economics and protect those huge profit margins forever. And it has to defy history by somehow avoiding the fate of Cisco and Microsoft.
So what's the big takeaway here? It's really about learning to think with 2 minds at once. You have to appreciate the amazing story of a company like Nvidia, but you also have to look cold and hard at the math behind its stock. One is about the business, the other is about the price.
So the next time you hear about a can't-miss stock, just pause for a second. Instead of asking, "Is this a great company?" ask yourself a much smarter question: what level of perfection is already in the price? That little shift in thinking can make all the difference in the world.